Hi there, this is Hugo. I've been digging through the latest 10Q of a tiny tech company operating out of Utah, and I think I've found something special. It's an obscure, under the radar business that is quietly positioning itself to become the absolute toll bridge for the United States food supply chain. Here's the setup. If you're a major grocery store, you simply cannot afford to sell tainted spinach. ReposiTrack provides the digital plumbing that ensures every single head of lettuce or bag of flour can be traced entirely back to the specific dirt it grew in. It's a completely hardware-free software platform, but here is why it caught my eye. The FDA is rolling out strict new traceability mandates, and the entire food industry is scrambling to comply. Instead of just passing data around like a post office, ReposiTrack uses over 500 algorithms to actively detect and autocorrect bad data from suppliers. Once a retailer mandates this system for their thousands of suppliers, the switching costs become absolutely massive. Let's break down exactly what they sell. ReposiTrack operates a B2B network offering three main things: food safety, compliance, and traceability. The brilliance here is the network effect. As more large retailers demand their suppliers use ReposiTrack, the platform becomes the dominant infrastructure of the industry. It's a classic toll bridge. Who wants to risk ripping out the only compliance system that your biggest customers and the FDA already trust? And despite this dominant niche position, it's a tiny fish. We're looking at a market cap of just $0.14 billion, with 18.20 million basic shares outstanding, sitting quietly in the application software sector. Now, let's look at the ugly truth, because no business is perfect. First, there's the risk of a massive cybersecurity breach. This one is material. Imagine you own this whole business, and a hack shatters the trust of the grocery giants. The network would collapse. And second, there's the execution risk of onboarding thousands of suppliers before the FDA deadlines hit. Right now, the market is nervous they'll choke on their own growth as the FDA deadlines force a massive bottleneck of panicking suppliers trying to onboard all at once. But here is what the panic sellers are missing. As for the onboarding bottleneck, it's a temporary headache. They are built to scale when the floodgates open. Let's get into the real money. I don't care about Wall Street's accounting earnings. I want to know how much cash we can pull out of the register. We begin with the cash this business actually generated, $6.87 million in operating cash flow. Next, we subtract stock-based compensation. They paid out $0.46 million in shares to employees. That is a real cost to us as owners, so we pull it out. Now, working capital showed a drag of negative $2.76 million, but because this is a purely digital asset-light SaaS business, that drag is just timing noise from prepaid contracts, not a real cost. So we neutralize it, adding back $2.76 million. Finally, we subtract maintenance CapEx. I use their 5-year historical average of 1.34% of revenue, which comes out to $0.30 million. After all the real costs, this business put $8.87 million in our pocket. When we take that $8.87 million and divide it by their 18.28 million diluted shares, we are looking at a very clean 0.49 in owner earnings per share. This brings us to the moat. ReposiTrack generates a return on invested capital of 14.78%, which is fantastic. But the real magic is that roughly 99% of their revenue is recurring. And look at this compounding engine. Over the last 5 years, their true owner earnings have grown at a compound annual growth rate of 30.92%. They are doing this without needing to build physical factories. It's just a few more lines of code to add a new customer. Their balance sheet is a fortress. They are sitting on $28.31 million in total net cash, with virtually zero debt, just $0.40 million in minor obligations, and management is acting like true owners. Instead of blowing that cash on fancy headquarters, they spent $4.35 million buying back their own stock and paid out $1.66 in dollar dividend yield over the trailing 12 months. So, we run it through the 4 pillars. Do we understand it? Yes. It's B2B software making sure grocery food is safe and compliant. Are the economics durable? Absolutely. With 99% recurring revenue and massive network effects, the economics are incredibly sticky. Is management honest and acting in our best interest? Yes. They are aggressively buying back stock and cleaning up their capital structure. Finally, is the price attractive? Yes. The market is valuing this at a current multiple of just 12.37x, treating a high-growth SaaS business like a stagnant survivor. Let's walk through the math to find what this business is actually worth. We use the total owner earnings of $87 million. I am applying a 20x multiple to that cash flow. Why 20x? Because this is a high-return business with almost entirely recurring revenue and a massive regulatory tailwind pushing it forward. Then we add back the Fortress balance sheet. They have exactly $155 in net cash per share. Multiply the earnings by 20, add the net cash, and we land at an intrinsic value of $11.35 per share. With the stock currently trading at $7.55, we are getting a 33.5% margin of safety. That is a massive discount for a business with this kind of quality and tailwinds. My honest verdict, this is a buy. We are looking at a high-quality toll bridge operating in a completely essential industry, and Wall Street is letting us buy it at a cigar butt price because it's too small for the big funds to care about yet. At $7.55, we are getting a 33% margin of safety, well inside my buy zone of $8.51. That is a wonderful business at a bargain price. But as always, this is just my analysis. You need to do your own research and see if this fits your portfolio. If you enjoyed this deep dive, hit subscribe so we can look at more wonderful businesses together. Thanks for watching, and I'll see you in the next one.